Now let's talk about the distribution. So remember that price cycle? We had accumulation and then a markup, price goes up, and then we have a distribution by big interest. Basically, the phases are going to be the same. A is going to stop the uptrend. B is all going to be about supply and demand. C is going to test the previous highs. D is going to be our markdown in the trading range. And then E, phase E, is going to be our markdown in the downtrend out of the trading range. So what kind of Wyckoff points are we going to have? Well, it's almost reversed. So instead of the selling climax, we're going to have a buying climax. Instead of the automatic rally, we're going to have automatic reaction. This is the first reaction that's going to be larger than any of the previous moves to the downside in the uptrend. Buying climax is going to be precipitated by the preliminary supply, and it's going to fail. And then out of the automatic reaction, we're going to have a rally that's going to be a test of the buying climax. And that would conclude phase A. Then let's go to phase C right away. The highest point is always going to be an upthrust. So for accumulation, we had sprints, we had shakeout, we had a last point of support. For distribution, we're going to have an upthrust, and we're going to call it upthrust after distribution, or UTAD. We're going to have the test of that UTAD, and we're going to have, instead of the last point of support, we're going to have the last point of supply. So almost the same. And then one more point that I want to mention is a sign of weakness instead of the sign of strength in accumulation.